This video is going to go over a marketing mixture analysis report and model that was done for a client of ours. We took a look at data from September 2023 to April 24, extracted it from various marketing platforms, and then analyzed, well, what's having the biggest impact on revenue, as well as how are these variables related to one another. So we're just going to start off by looking at some charts and some correlations. So here's the different variables that were pulled from different various paid media channels, as well as users and emails. It was over 35 weeks. Here's revenue over time. Here's Facebook and ad spend over time. You can certainly see that there is some correlation. The more that Facebook spend spiked, the more that revenue tended to spike as well. But there's also a more quantitative way we can measure correlations, and that's by looking at the correlation coefficient. So this heat map is the correlation coefficient of every variable with one another. So how correlated is revenue with itself? Well, that's a perfect correlation of 1. This coefficient ranges from -1 to 1, where -1 is a perfect negative correlation, 1 is a perfect positive correlation. So you can also see the next most correlated variable with revenue has been Facebook spend. And this is in terms of weekly spend. So the more that weeks Facebook increased, the more that revenue increased as well. And that's the most predictive of all these variables is Facebook with revenue. Then the next most correlated has been email opens. So the more that emails are opened, the more that we can accurately predict revenue is going to increase. They also have a channel called Share a Sale, which is you only spend money when someone makes a sale. So that one, there's been a lot less spend on Share a Sale. So there's a lot of variation, but it also was weekly correlated with revenue. And affiliate traffic, this is in terms of users, and it actually, interestingly, has been slightly negatively correlated with revenue during this time period. So this is the period without Google Ads because Google Ads was only active during the last 2 months of data for this client. This is just another way to look at correlations with these scatter plots. So you can see Facebook spend, there's less variation around the line of best fit compared to these other channels. All of the dots, which are weekly spend in terms of Facebook and revenue, they are most closely centered around this line. So that's what kind of they look like visually when variables are more correlated versus email opens and Share a Sale. They are positively correlated as the overall trend, but there's a lot of variation week to week. So here's the same heat map, but during the time when Google was also active. So we have less data, but we also see Facebook spend has been the most correlated with revenue, followed by Google Ads. Still very strongly correlated, but slightly less than Facebook, just barely. The same plots as before. As you can see, we have much less dots, so much less data available. That makes it harder to draw meaningful conclusions for Google, especially since most of these weeks had the same range of spend, just between around 2,800 and 3,000 per week. So we don't have enough variation in spend to draw meaningful conclusions. During this time period, Share a Sale spend, its correlation with revenue was pretty flat. You do see that it was a slightly negative correlation, but it's so barely negative that really you would say there's just no correlation during these weeks between how much was spent on Share a Sale and revenue. One super interesting finding from doing this analysis and just looking at correlations is that Facebook spend and Google Ad spend is also highly correlated with first user mediums from Google Organic and Direct. So this is not users that clicked on an ad. These are users that found the site for their first time, either typing it in directly or going to Google search. But you can certainly see that the more that this client spent money on Facebook and Google Ads, the more that users increased from Google Organic and Direct. So when you're looking at your revenue attribution and you're looking at, say, the UTM tracking attribution in Google Analytics, these are only users that clicked on the ad. It's not really capturing the full impact of your channel spend, which is a good benefit of using an approach like this, because we will be able to model that by using a statistical approach. So this client luckily had this time period where they paused their Google Ads so we can see also within the data itself what actually happened. So there was this 2-week period where here's Google Ads, here's organic, here's direct. It was high early on, they paused it. You can see organic and direct, they both steadily decreased and then picked back up right after Google Ads was restarted. How much did they increase with the restart? Well, the week before and after Facebook ads was restarted, organic then increased by 46% and direct traffic increased by about 31% during those weeks before and after Facebook ads was restarted. So we're looking at those correlations, we see that pattern. We can also investigate that the raw data itself and then confirm, yes, when they paused Google Ads, organic and direct decreased. Another thing we can do when we're looking at this data is take a look at, have any of our marketing channels reached a saturation point? So you can't expect that the more you spend money on Facebook and Google Ads and other platforms, they're just going to linearly increase your revenue at the same rate over forever. They're going to eventually reach a saturation point where you need to either rethink your strategy within that channel or perhaps just reallocate your budget to other channels that haven't reached this saturation point yet. So looking at the scatter plots and thinking about how this curvature might exist can help us understand if where we're at along this life cycle of a marketing channel. So Facebook ad spend, it's quite linear. I would say the biggest increase is from 0 to 2,500, the most dramatic rate of change. And after that, it's been quite consistent. It's quite a linear pattern. The more you increase Facebook, the more that revenue increased. I don't think we're at a saturation point yet. Share of sales spend, we don't really notice a big increase for after around $25 to $250, but this channel also has very low spend. It's hard to draw any meaningful conclusions. Google as well, we don't see a saturation point, but we don't have enough data to draw any conclusions really. However, we can break down Facebook within different platforms. So Facebook spend, it can go to audience, it can go to the Facebook website itself, and it can also go to Instagram. So Facebook itself looks quite linear. I don't see a point of diminishing returns. Instagram, however, if you were to just remove this outlier, which was a major holiday for this client, then you could see that after about 2,500, you don't notice a notable increase in revenue. The more that spend went from 2,500 to 5,000, revenue stayed quite flat. The overall trend was not an increase in revenue at the same rate as before, especially during this initial period. So Facebook's the one where I would say they may have reached a saturation point, or perhaps their strategy is not working and they could rethink what they're doing. And that was the client's feedback as well. They had some ideas on why it might not be working and they're going to revisit that channel. We can do the same for Google Ads. However, during these time periods, we don't have enough data, so the breakdown really isn't meaningful, but I still wanted to include these charts to help us understand, well, what can we look at again in the future as we collect more data. Now, that's just looking at correlations and what's the relationship like between just two variables at once, but we can also put all these into a model and understand what's the return on investment per channel, what's the return on ad spend when considering all variables at once. We want to know what's that marginal increase in just one channel and its impact on revenue while holding the others constant. So that's what the model can help us understand. And here's the overall summary from this model. We put all of it into a statistical model, and the model found that overall, for every $1 increase in Facebook, the coefficient represents that return in terms of revenue. So this is in terms of dollars. So a $1 increase in Facebook has been associated with a roughly $3 increase in revenue. And that's the same for Google Ads. The model came up with the same coefficient, but we're much more confident in Facebook. We have a lot more data. This result is statistically significant, and we're 95% confident the true return on investment in Facebook is somewhere between 2.2 and 3.87, or return on ad spend, I should say. Email opens, so this is in terms of an email open, which technically is cost of zero. So every one email open has been associated with a 27 increase in revenue. And we're quite confident that the true range is somewhere in between these two numbers, and it is a significant result as well. In this model, we separated out the holiday effects from normal weeks. One reason is to see how differently your return on investment might be during holidays. But really, this was done because Google spend was only during this major holiday for the client. So it would make it look like their ROI was huge, but really that was because it was during this holiday time period. But if you consider it not during a holiday time period, then it's quite even with Facebook. And then there's always going to be the baseline spend. So if all variables are zero, some users are still going to be coming to your website. So this is telling us what's that average amount we would expect if all marketing channels were at zero. This is just another way to visualize the return on ad spend and coefficient estimates, along with how confident are we in this result, where the red line is the error bars. So these are so small that you can't really even see the range, but we're most confident in our estimates for email opens and Facebook spend. And then Google Ads and ShareASale, we're really unconfident in these results, but our best estimates are 2.9 and $35 for ShareASale, which is very different because you're not buying ads, you're only spending money when someone buys something. But we have so little ShareASale data that it's hard to really come up with a good estimate from this approach. So here we're comparing just some other typical ways of attributing Facebook spend, which is this platform that the client's using. Facebook attributed return on ad spend was 1.96. This would be users that clicked on the ad. The client also likes to show it in terms of, not the client, but their agency likes to show it, the return on spend in terms of total revenue, as if all of your revenue is coming from Facebook. So it seems like they're trying to just make the point that the Facebook attributed isn't telling you everything. And that's true because it doesn't capture what's that effect from users who see your ads but don't click. But the modeling approach can do that. So this is including users that may be visiting your site from Google Organic or Direct. So they're saying, well, the true estimate is somewhere in between here, and we have that estimate at 2.9, and this would include users that are finding your site in other ways, because with the modeling approach, you're only looking at weekly spend and weekly revenue. We don't have any data on who clicked. We're not looking at that at all. We're just looking at the patterns between those relationships and those statistical findings of your weekly changes in these variables. We can also use the model to see what's the allocation of predicted revenue in terms of percentages. So for the last 2 weeks, the model would say that 40% of your revenue came from Facebook, 26% from email opens, and then there's also that baseline of what you expect if all channels were at zero. And then, to a lesser extent, there was ShareASale and Google Ads. Not as much has been spent on Google as Facebook for this client. Also, if we had more data, we could also do like a budgeting allocation. Like where you have different scenarios. Say if you decrease Facebook and spent more on Google, what would you expect to have if it happened? But we don't have enough good estimates for those other channels to really do that type of work. But it's another thing that can be done if the client has more data. So there's the takeaways. There's some other additional findings in the appendix. This is looking at previous week spend of Facebook. So previous weeks are still correlated with revenue. There are also other approaches to model that effect. You put in this decay rate and model like what is the spend from 3 weeks ago correlated with revenue. How much does that impact revenue in your model? But we don't have enough data to do that type of thing. This is just showing that previous week's spend on Facebook is still correlated with the current week, and that declines the more that you look back in time. So 7 weeks ago, the face spend is not correlated with this week's revenue, but 2 weeks ago is still very positively correlated, just not as much as the current week. So that's the whole thing. There's a couple other additional slides here, not as important as the rest, but thank you so much for listening, and that is the presentation.